Hey everyone, welcome to Savvy Fundamentals. This is my very first video. Today, we're diving into a hot topic, the Federal Reserve's recent decision to cut interest rates by 50 basis points. We'll explore what this means for the global economy, the potential risks ahead, and how it could impact stock markets, especially in the UAE and India. Stick around as we break down these important trends and what you should watch for in the coming months. So, what exactly is a 50 basis points rate cut? Well, the Federal Reserve lowered its benchmark interest rate by half a percentage point to stimulate economic activity. The idea is simple. Cheaper borrowing encourages businesses to invest and consumers to spend. It sounds like a good thing, right? But such a big cut can also indicate deeper concerns about the economy, like slowing growth or rising recession risks. Let's talk about how the markets reacted to this news. Stock markets tend to rally because lower rates can mean higher corporate profits and increased consumer spending. However, there can also be market volatility, especially if investors think the rate cut signals that the economic situation is worse than expected. In the bond market, yields typically drop when rates are cut, indicating expectations of slower growth. The US dollar also tends to weaken, which can benefit exporters but could lead to higher prices for imported goods, contributing to inflation risks. To understand the potential impact, we need some historical context. Since 2001, we've seen several major rate cuts. After the dot-com bubble and the 9/11 attacks, the Fed slashed rates, fueling a housing boom that eventually led to the 2008 financial crisis. Then, during the global financial crisis, rates were dropped near zero to stabilize markets. The COVID-19 pandemic in 2020 brought rates down again, and the aggressive rate hikes of 2022 aimed to combat high inflation. Now, in 2024, we're seeing another rate cut. It raises questions about whether we're heading down a similar path to past financial turbulence. So, why are some experts worried? The main risks include asset bubbles, as prolonged low rates can drive stock and real estate prices to unsustainable levels. The Fed's credibility could also be in question if aggressive rate cuts suggest deeper economic issues. Moreover, inflation remains a risk. Cutting rates might stimulate growth, but it could also trigger another inflation surge, especially if supply chain problems persist. And let's not forget about debt. Low borrowing costs encourage more debt accumulation, which could be problematic if rates need to be increased later. Now, let's bring it closer to home for those in the UAE and India. For the UAE, a weaker US dollar could push oil prices higher, benefiting the economy. This would be good news for energy stocks, but if global growth slows, demand for oil might drop, causing market volatility. In India, a stronger rupee could help ease inflation and potentially lead to lower interest rates by the Reserve Bank of India, benefiting sectors like consumer goods and manufacturing. However, a global slowdown would still pose risks, especially for export-driven industries such as IT services. As we wrap up, keep in mind that while the Fed's rate cut could provide short-term relief, the long-term effects are uncertain. Markets in the UAE, India, and worldwide could see gains, but the risks of a global slowdown remain. Thanks for tuning in to my first video. If you found this breakdown helpful, please like, subscribe, and leave a comment. See you in the next one.